Hello and welcome to Inderes TV. Let's talk about Sampo with Analyst Sauli Vilén. So Sauli, Sampo published its Q3 result last week. In a nutshell, how does Sampo perform?
Well, Sampo performance was in line with our and the overall market expectation if you look at the group level figures. But then if you look under the hood, so to speak, it was somewhat soft in there. Since even though the overall result was in line, the insurance operation was a bit soft, and then again the investment income made up for that. But obviously for investors, the investment income is not as important or valuable as the investment operation itself. But in the grand scheme of things, you look at the broader perspective, Sampo still performed really well if you consider the current environment with the inflation, rising interest rates, economy slowing down, etc. So in that sense, they performed really well still.
If of course Sampo's hard, so what was behind If result? It was a bit soft.
Yeah, it's kind of funny when it was soft compared to market expectation. Yes, it was the investment income fell behind expectation, but as I said before, it really doesn't matter in that sense. But what was the main driver behind the disappointment, which also showed in the share price in that particular day, was that the combined ratio or the insurance operation itself fell a little behind of the market expectations. But that was due to the large claims mainly. But I mean, then again, if you look at that market was expecting Q3 combined ratio to be 80, it landed at 81.6, and for the first 9 months you are still rolling around 80% combined ratio, which is like insanely good figure still. It's a level what like 5 years ago you could have dreamed of insurance company to have. So in that sense, still the performance is still superior, but obviously the market expectations are the market expectations, and they fell from that. So that was the softness. But overall, still, if it's growing nicely, they don't have any problem with the claims inflation, etc. So still, the underlying performance is rock solid.
So we can still say that If is the best insurer company in Nordics.
Yes. I can underwrite that, definitely.
Yeah. All right. What about the market situation at the moment in Nordics? It has been extremely well for these companies if you look at, for example, to Great Britain, but how does it seem in the future?
Obviously, the market situation is still really good. And I mean, I have been covering Sampo for over a decade now. The market situation in the Nordic perspective has never been really poor. As the Elliott Asset Management said when they were a shareholder in Sampo, when they had to simplify Sampo operation, they said that the Nordic insurance market is the best insurance market in the world, and that's probably true actually. Since I mean the Nordic market, the dynamics is just really favorable for the companies. We have only handful of players, all have large market shares. The barriers of entry are super high. So in that sense, the landscape is really favorable. And that basically allows Nordic companies to have superior combined ratios all across the board. Obviously, it's not just the market dynamics. Also, the Nordic players are all really good, for example, in the digitalization, etc. So that's also one thing that raises the barriers, since it's for the Nordic players are mostly the forerunners in this game, and thereby it's actually really hard from the Central European player, for example, just to come here, since they are so far behind in that sense. But and obviously in Sampo's sense, it's also good to remember that Sampo operates in all 4 Nordic markets. If you combine top Denmark, where Sampo owns roughly 50%, they are also a major player in Denmark. And so basically, since you are in all 4 markets, we can talk about Nordic insurance market, but each market is unique. Obviously, they all has the same dynamics in that sense that there's a handful of players and obviously economies are very stable, etc. But in the but you have 4 different markets, and thereby, like for example, if let's say in Finland that some big player like OP or somebody would start a real aggressive price war or something that would change the combined ratios for the whole industry and profitability for the whole industry, it wouldn't affect Norway, Sweden, or Denmark, and then basically so that also that brings that stability to if there would be some more fierce price competition in some market, it wouldn't affect 3 other markets in that sense. So that's just good to remember. But yeah, all good in the market situation front, definitely.
One thing that is affecting all the markets is the interest rates. They are coming back, finally getting back in the game. So could you elaborate a bit? Why is it so big thing?
For insurance companies?
Yes.
Well, yeah. First off, if you look at the short term, obviously insurance companies are large investors, and their portfolios mainly consist of bonds. So obviously, when the interest rate skyrocket, the price of bonds plunge. Obviously, that wreaks havoc in their investment portfolios. Obviously, in Sampo's case, the damage has been fairly limited since Sampo has been in very short duration in their portfolio. But that's obviously what that translates is to the long-term gain. Since when the interest rates skyrocket, it obviously allows you to lock future returns for much more lucrative yields, right? So the running yields of the portfolios of or competitors have actually gone up significantly, which will mean that the short-term pain which you are having will actually mean that in the future you will earn a lot more from your investment portfolio, which is actually how traditionally the insurance companies have done their money. But that's the investment side. Then I think actually the biggest thing which we have talked before is that if you look at the fundamentals of the insurance companies, you do money 2 ways. You have the underwriting business, the combined ratio, so to speak, and then you have the investment income, which we talked there, right? So basically, those are the fundamentals. And when we haven't had the investment income component so much because of the 0 interest rates, etc., so the underwriting has been the dominant part here. Everybody's focus has been on the underwriting. Underwriting combined ratios have come down significantly. But now, the dynamics might be changing. Since this is, the interest rates, when they go up, you will get the investment income. So obviously, if the competition works, etc., it would mean that the combined ratio should go up. Since obviously, if you have the investment income, it would encourage you to have more market share there in the underwriting side, basically. So that's something what I think will happen at some magnitude, that the earnings mix, which has been very heavily weighted on the underwriting, will somewhat move towards the investment income. But it's also safe to say that we have moved permanently for the lower combined ratio environment. I don't see that we will go back to the environment where we were like decade ago. I think decade ago Sampo's their long-term target, or if long-term target was to land under 95% of combined ratio, and then now they are at 80, and they are so we are not definitely moving back there. But that's something investors should focus on, since obviously the underwriting result is much more valuable for investors than the uncertain investment income.
Of course. Then final question about the Sampo's valuation. It's one of the few stocks that has performed quite well this year. Any thoughts about valuation?
Yeah, well, obviously the Sampo's operational performance has been rock solid. The business is really defensive, and Sampo is at least on the short Sampo kind of benefits for the rise in interest rate in that sense. So definitely that's something which has helped the stock a lot. But if you look at the Sampo's valuation, I still think even though Sampo is not anymore a conglomerate or anything, Sampo is a pure play insurance company, it's still fair to look it through sum of parts. That's because you still have a lot of excess capital. You still have those PE investments like from blast in the past from the old conglomerate structure. You also have life business, which should not be valued at the same level as If. You also have Hastings, which obviously it's a P&C insurance, but it's still, well, it's in the UK, which is a terrible market comparing it to Nordic markets, and obviously Hastings is not like the dominant market player or anything, so it's a challenger in that sense. So obviously it should also be valued differently than If. So taking all of these together, and also you only own 50% of top-down mark. So in that sense, the sum of parts works good here. The price is around pretty good in line with the sum of parts at the moment. I mean, the current the undervaluation which Sampo clearly had like a year ago or so, it has all vanished basically. Sampo is now fairly valued. The If's valuation is in line with the best Nordic peers. Overall, as they have shrunk their balance sheet, there is not so much hidden value anymore in there. So the valuation is actually fair from all of the perspectives. So I mean, in order to have clearly higher sum of parts valuation, you either need higher earnings estimates, which would basically require that when investment income comes back, the combined ratios stay at the ultra low level. And then, or the other way is that actually we will start to price If with a premium to other Nordic players. That was actually, by the way, the Elliott management case, that since If is so fantastic company, it should be valued at premium, which is actually not a terrible thesis. I mean, it's actually a good thesis. Since If is the best one, as you said at the start of the video, so that would make sense actually. But then again, I think the current environment where interest rates are rising and the acceptable valuation levels are coming down, this environment is not the environment where you want to bet on multiple expansion from rich valuation levels to very rich valuation levels in that sense. So that is not. I mean, I wouldn't bet on it, even though that can happen, and it's good to acknowledge that. And thereby, basically, the stock is fairly valued. You get a really nice dividend yield still, super reliable dividend. The basic dividends are growing, and some extra dividends top of that. So in that sense, the risk reward ratio, it's kind of it's a little bit on the positive side, but not enough for the positive recommendation. So that's why we are for first time in years in reduce.
That's about it. Thank you, Sauli, for clear answers.
Thank you.